this is Matt from Speak Straight Mortgage. In this video, we're going over a seller paid 1-1 buy down. What it is, why you would use it, what it looks like. The first step, in my opinion, to best understand a temporary rate buy down is to consider it a supplement to a regular loan. So, because it uses seller concessions, which can be used in a number of ways, a temporary buy down is just one of them. So to start out, we need to get the standard loan to base it off. So in this case, we're going to use a $500,000 purchase price VA loan with zero down and a rate of 6.25. The total monthly payment in this scenario is $3,603. That's including estimated property tax and homeowner's insurance. Okay, so we're starting with that. And so now we'll get to the real world scenario. So you're pre-approved for a house. That's your standard loan. You're going shopping at houses in the price range of $500,000. The seller is having a more difficult time selling in this market with higher rates because people are sitting on the sidelines waiting for rates to drop. So your real estate agent, if they're good, can potentially negotiate concessions. What are concessions? Basically an incentive for you to buy. So in this case, the cost of a 1-1 buy down, and what is a 1-1 buy down? Well, it's basically saying your 30-year mortgage, which we started out with, was 6.25 rate. This is going to reduce the payment to be the equivalent as if it was 5.25 or 1% reduction. That's where the 1 comes from. And the same thing for the subsequent year. That's where the second 1 comes from. So it's 1% reduction the first year, 1% the second. There are also 2-1, 3-2-1 buy downs, and 1-0 buy downs. They follow the same thing, basically structure. So anyway, so we're going back to the house. The realtor negotiates incentives for you to buy, which are called concessions. You can use those concessions. In this case, a 1-1 buy down costs $7,785. The realtor negotiates this concession. Money goes in an account, call it an escrow account. Every month, part of the monthly payment comes out. So your payment is $3,603, but out of this amount the seller has funded that your agent has negotiated, $324 comes out. So your actual payment that you are making is $3,279. So a $324 reduction that the seller is paying. The second year, same thing, $324 comes out of this account. By the time the 1-1 buy down is complete, after the 2 years are over, this 1-1 buy down escrow account is empty. But if you were to refinance in the time before it is empty, any money left over in this account is refunded to principal. So the benefit is you're getting a house potentially at a lower price because there's less competition. You're getting the benefit of a 1% reduction in rate because the seller is funding it because they're having a more difficult time to sell. And basically the one way you look at this as a strategy is if you waited for rates to drop 1%, the price of the house is going to be more than $7,785 increased. So you will get the benefit of the lower priced house, you still get the payment, and you still get to refinance when rates drop. So that's kind of the summary of a 1-1 temporary buy down and why you would use it.